Invesco Global Market Strategist. Brian, it's great to have you here. So I'm curious just to get your reaction to what we heard from Powell, not only at the press conference last Wednesday, but also what we heard in 60 Minutes last night, and what that means in terms of your expectation for a rate cut.
Well, first and foremost, I'm thrilled that we're done with the tightening cycle, right? That is critical. I think the market's priced in too quickly the 6 interest rate cuts. And, you know, that rally, that cyclical, everything rally in November and December, I wish it would have lasted a little longer. So now we're recalibrating. Basically, what we heard is that don't expect the 6. We are done tightening. We'll slowly bring down rates, but we'll be data dependent as a result of it. To me, it's not a huge issue for markets, but just a shift in leadership, so to speak.
What's the real number of rate cuts that you believe that we're going to get this year?
Probably looking more around 2 or 3 rather than 6. I think the market went to 6 because that would have normalized the yield curve. And at some point, if you don't need 5.25 funds rate, if we're not going to be a 5% nominal growth country, which we're not. So at some point you normalize it. But I think the big challenge for investors now is the normalization of the yield curve typically means weaker dollar. It means small caps, mid caps value. That all happened in 2 months. And so now you're getting a bit of an unwind of that stronger dollar, rates up a little bit, more tech outperformance. So that may be tripping investors up for a little bit. I would say if you're looking over the next 1 to 2 years, focus on that normalization of the yield curve because it is going to come.
So I'm happy you brought up the small cap discussion, right? Because we've been talking a lot about the fact that maybe that a lot of that optimism had already been priced in. We have not seen that trade really take off, at least since the start of the year, given the outperformance that we've seen in tech. What do you think the volatility that we've seen within that play, and we have the Russell 2000 up on the screen right now, tells us about some of that price action that we could see in the coming months?
Well, we were up 20% in small caps, Russell 2000 in 2 months. So you got a bull market in a blink of an eye. And, you know, for people like me who write outlooks in October, that's your call for the whole year, right? And it happened in a blink of an eye. So what do small caps need? They typically need easier policy. They need a cyclical upturn in economic activity. So you were getting that soft landing feel. Now you're just pricing some of it out with, not pricing out soft landing, but recalibrating where interest rates are going to be. So small caps fall under some near-term pressure. But again, small caps do very well as the Fed eases, as you normalize the yield curve. So we still have that ahead of us. We're just in a patch right now that's favoring mega cap again.
Internationally, as you kind of look across the global scene here, where are there the pockets of pressure that you're seeing that are cascading into portfolios where investors should be making some type of pivot?
Well, I think what investors probably are missing in places like China and in Europe, growth had already deteriorated pretty significantly, and you're below trend in those parts of the world, but actually maybe starting to improve a little bit. Now, don't get me wrong, stronger dollar is disruptive of that, so you will need some carry through in terms of, you know, rate differentials between the U.S. and the rest of the world narrowing. So the dollar under a little bit of a pressure right now hurts international, again, in the near term. I hate to keep saying the same thing, but thinking out over the next couple of years, will we finally be out of this COVID cycle? Will we finally have a normal yield curve, reasonable growth, normal inflation? I would say yes, and that's, to me, when you start thinking about beyond the U.S. mega cap.
What does that normalization look like, though, right? When we talk about the fact moving beyond the movements that we've seen and the astonishing activity that we saw during COVID, getting back to those more normalized rates, I guess what exactly does that look like to you?
Well, if we think about it, I mean, what a crazy 4-year period, right? And so you shut down the global economy, put a lot of money in people's pockets before the world's ready for it, raise interest rates 525 basis points, and now we're battling back and forth. Soft landing, no landing, hard landing. What does it mean? It means that over time, the Federal Reserve has to ease policy in a more normalized. We're not going back to 9% inflation. Inflation's coming into the 2s. We don't need 5.25 Fed funds rate with inflation in the 2s. And so we're going to slowly bring down rates, and we're going to get back to an environment where short rates are below long rates, the way it's supposed to be, and that'll reinvigorate credit and reinvigorate economic activity.
In order to get back to that normalization, we're going to have to move through one of the biggest election years worldwide that we have ever seen.
Yes.
What type of headwind, what type of volatility could that ensue?
Well, my message to investors for years has been that focusing too much on politics or the government is not a great investment strategy. In fact, the way we used to say it was hating the government is not an investment strategy. And in the U.S., there's going to be a lot of focus, Trump v. Biden, which we assume will be the race. If you go back and you look historically, you can go back to Eisenhower, just about every president experienced positive returns over their term. And if for all the focus since 2016 and 2020, if you look, Biden was elected something like 820 market days ago. The market is up 46, 47% since that election. What do you think the market was up in the first 820 days after Trump was elected? About 51%. So they're just about neck and neck. These things don't matter nearly as much. I would focus far more on the Federal Reserve than I would focus on what outcome we get in the executive branch.
Brian, always great to get your insights, the context here. Thanks for joining us in the studio.
Thank
Brian
you.
Levitt, Invesco Global Market Strategist, everyone.